It finally happened. The US debt rating has officially been downgraded, and everyone is going to be impacted by this, but especially those who are planning to retire. Hi everyone, I'm Taylor Kenney with ITM Trading, and today we're going to be talking about how the US debt downgrade will directly impact your retirement plans. There are so many ways that this hurts your financial plans, but today we're going to focus on how we got here, what actually changes, and how you can prepare today to protect yourself. Just like you have a credit score, countries or companies can have a credit rating, which can go up or down and is dependent on factors such as one's ability to fulfill their debt obligations. Also, like a personal credit score, the score goes up and good things happen. The score goes down, well, maybe you're not eligible for that 0% APR credit card anymore or a low interest loan. But the difference here is, of course, when we're talking about countries, this is felt on a massive scale. There are 3 big credit rating agencies that account for 95% of the ratings: S&P, Moody's, and Fitch, or the big 3. The big 3 rate on a scale with the most sought after being AAA and the least being D. You might be familiar with these agencies from their role in fraudulently rating securities that helped lead to the mortgage crisis in the 2008 Great Recession, rating securities as AAA when in reality they were junk. We will talk more in a minute about how a lot of standard retirement options are based on things completely outside of your control, such as ratings, the value of the dollar, a future CBDC. But first, let's dive into more about what just happened this week. The United States debt has historically had the benefit of having the top tier rating, a AAA, ever since Moody's first rated it in 1917. That AAA rating represented that the United States had one of the safest, biggest economies, and therefore was a safe and sure bet when it came to debt and repayment of debts. S&P and Fitch also followed suit and assessed the United States as a AAA rating, which had been held in place up until 2011. In 2011, S&P decided to reduce their rating to a AA+, citing a heightened trajectory of debt and increased political unrest, and to this day, they stand by that decision. Moody's and Fitch, however, kept the pristine AAA rating in place this entire time since, that is, until this week. Fitch joined S&P in downgrading the U.S. debt rating, citing an erosion of governance, fiscal deterioration, and a growing debt burden. This isn't a shock, right? We know we have a debt problem, and we know there's been a retirement crisis looming for a long time. With more and more baby boomers retiring and fewer people working, Social Security reserves are on track to be depleted within the next 10 years. Where is that money going to come from? Costs are rising faster than revenue, and the U.S. government is complacent. This, combined with a variety of other indicators, has made Fitch suggest that a recession is not only incoming, but imminent. So that's where we are today. But AAA to AA+, does it really matter? It still has an A in it. Isn't it all the same? No, not at all. Yes, it does matter. Out of the big 3 before this week, since there were still 2 of them rating the United States at a AAA, the United States still benefited from a AAA status. Now that Fitch has changed to a AA+, the United States has officially been downgraded to a AA+. When a credit rating is downgraded, it means that there's a higher interest rate to compensate for the higher rate of default that it possesses. And this is key because of the ripple effect it has. Mortgage rates go up, stocks and bonds tank, in turn your 401k tanks, pension funds falter, credit access is limited, the list goes on and on. Think about retirement plans that have government bonds in them that today are rated lower, but those rates go up. What is going to happen? Do you see where I'm going with this? The impact that this could have on your retirement plan is tremendous. Not to mention the big picture that the US dollar itself is impacted. A downgrade in debt rating is basically saying that there is less faith and trust in the United States government and in turn in the US's fiat money, aka the US dollar. Before the downgrade happened this week, I actually was already planning on making a video about retirement. And in that video, I was going to call out that one of the most concerning things that I hear when I hear people talk about their 401k or Social Security, even if the conversations are looking ahead, is that inherently a lot of those conversations are based on the assumption that the US dollar will still carry the same value that it does today. This is a perfect example of how quickly things can change. Our own government was not anticipating this announcement. They were shocked, surprised, and baffled by it. If it were me and I had a bunch of credit cards that I maxed out and I was still somehow finding ways to take out more loans and I had a ton of debt and then I go and check my credit score and it had dropped, would I be surprised? Not at all. I would be expecting that. The fact is there is a clock ticking for the US and the US dollar. I've talked about BRICS and other threats to the US dollar, but as de-dollarization continues to build momentum, there are going to be impacts not only on our economy and the global economy, but on the value of the dollar and in turn on your retirement. Lynette talked about this week. What are your bonds, your 401ks, your pension plans? What are they all made up of? Dollar-denominated assets. It's so simple, it's scary. The dollar loses value, you lose money. And now on top of that, you have to worry about all of this. With interest rates going up, you're going to be losing money and being cheated out of your retirement at an even faster rate. What we saw this week shows that there has never been a better time to reassess and create a strategy now. Something that's been on my mind is, have you considered the impact that a CBDC rollout will have on your retirement? As we all know, many retirees depend on support that's issued from the government to supplement their retirement, such as Social Security, pensions, medical costs. Let's fast forward here. A CBDC launch has happened, but you're not interested in using it at all. Good, I don't blame you. But let's say you're retired and you're relying on these payments to survive, and the government announces that they are only going to offer these payments moving forward in a central bank digital currency. What are you going to do? They've got you. You're already retired, you're dependent on them, you might not have much of a choice in the matter. You want your pension? Yeah, no problem, just gotta get it in a CBDC. Oh, Social Security? Absolutely, just sign this form right here. It's gonna come in our central bank digital currency. I mean, look at China as a case study. China currently has the largest CBDC pilot in the world, both in terms of the amount of currency being used as well as the amount of participants. Last month, they unveiled that they want to add their digital yuan, their CBDC, to their Social Security cards as a payment method. In China, their Social Security cards are actually smart cards. In 2018, Chinese banks were granted the approval to issue Social Security cards. They have a chip on them, they could be linked to a user's bank account and used similar to a debit card. By adding CBDC options to these Social Security cards, China believes they'll get more adopters. Specifically elderly and rural populations who typically might not have smartphones or be as savvy and understand how to use the CBDC or not, but they're already used to using their Social Security card for payments. What are they going to do? Say, no, I don't want my Social Security payment? It's a blueprint for what could happen here in the United States. Okay, so what can you do today? Well, when we talk about these concerns, there are a number of things to consider. The first being, any good advisor will tell you not to put all your eggs in one basket. So why would you do that with your retirement? Why would you have everything in a dollar-denominated asset? Because essentially, if something happens to the dollar, all of your assets are at risk. This downgraded debt rating also might not be felt today, but trust me, it will be. And the last thing you want is your retirement in jeopardy because of the US government's poor fiscal decisions. The next thing to consider here is what options are available to you outside of the system. We know that a CBDC rollout is coming and that one of the levers that the government is likely to pull is going to be offering payments or assistance within their central bank digital currency. And with retirement specifically, it's extra concerning because if you haven't set yourself up for success by having another stream of income or having wealth management and protection outside of the system, then what are you going to do? If you are reliant on the government's payments, they're going to be able to dictate how and what you spend that money on if it's a CBDC. Do you think that they're going to let you spend that central bank digital currency outside of the system? On gold, on crypto, on anything else? Absolutely not. That is why it is so important to set yourself up now, so that even if you supplement your retirement through government programs later on, not everything is within the system. This way you're protected against debt rate downgrades and corresponding interest rate hikes, inflation, de-dollarization, and programmable money, or whatever else they throw your way. The first question here is, what do you want to achieve? What do you want your retirement to look like? The next step is making sure you have the proper plan in place. Listen, the more independent you are, the more free we all are. There's strength in numbers, so please keep educating yourself. Click the free strategy link below and get prepared now. Once again, thank you for diving into all things retirement, debt, CBDCs, and most importantly, how to protect yourself. I'm Taylor Kenney with ITM Trading. Until next time.